U.S. mortgage rates jumped higher again last week amid the U.S. debt ceiling discussion. According to the Federal Home Loan Mortgage Corporation, Freddie Mac, 30-year fixed-rate mortgages up to nearly 7% is the third jump in a row, plus another rate hike is possible by the Fed, and that could impact mortgages as well. Higher rates tend to push up bond yields, which leads to higher mortgage rates. Still, earlier this week, a report by Case-Shiller showed that March home prices rose slightly compared to last year, and that's indicating what could be a recovery now in the sector despite the mortgage challenges. And the U.S. commercial real estate market is facing its own crisis. Prices falling in the first quarter of 2023 for the first time in more than a decade. The pandemic, obviously a significant impact with the rise of remote work, and it could have spillover impacts to several other sectors. Benji Heyer explains.
The 9 to 5, the commute, the office. Is it all a thing of the past? More people are returning to the workplace, but coronavirus has changed the game. And the economic effect of the pandemic is sending commercial real estate prices down by almost 1%.
There's a lot of headwinds right now facing commercial real estate. So first and foremost, you have elevated interest rates. The Fed basically hiked rates from 0 to 5% in a very short period of time. Those elevated interest rates put downward pressure on commercial real estate prices. I think on top of that, we've got some of these longer term, I'll call them structural changes right now, particularly around working from home. So you've got more and more folks who are spending time at home, and as a result, they're not spending as much time in the office and in the associated sort of spending environments, all of which tend to be really prime locations for commercial real estate.
And analysts suggest those longer-term trends are likely to persist for the next decade.
It's going to take some time to figure out where people exactly are going to be spending most of their time. And it would not be surprising to me if you had properties that were based in city centers close down over time, and eventually things would be rebuilt more in the suburbs and exurbs.
Bad news for the banks. That's because they account for nearly 2/3 of the $3.6 trillion in outstanding commercial real estate loans. Smaller institutions are left particularly exposed at a time when several have already collapsed under the strain of interest rates. Further rate rises to counter inflation could make it even harder to retain deposits and would push up the cost of loan repayments. So property owners are looking elsewhere for a solution. With more students than space at some colleges, their answer could lie here.
Universities are expressing an interest in leasing office spaces, since they want to bring back to the class the students, and with providing an office space like a space that is very close to what it is like in the office space with high ceilings, this can bring like more students back to the class.
Yet, as office blocks across the country remain empty, construction of commercial space is still on the rise. The hope that the sector can build back from the brink. Benji Heyer, CGTN, Washington, D.C.
For more on this big topic on commercial real estate, Ted Rossman joins us, Senior Industry Analyst, bankrate.com, creditcards.com. Good to see you again, Ted. Had this been a year ago, we'd probably be in crisis mode. But now that we have our friends like Elon Musk and all the other big companies saying, get back to work or else, it seems to me that there has been some mitigation in this crisis, that people are going back to the office, albeit maybe not 5 days a week, but 3 days a week. What's the current state of the commercial real estate right now?
It seems like we are going to have to find a new normal with respect to hybrid versus in-person versus fully remote. I think the answer really depends on the individual company and sometimes even the individual worker. Broadly speaking, the commercial real estate market is under a good bit of stress right now because of fewer people going to the office, because of more vacancies. There's a lag to a lot of this because we're generally talking 3-year, 5-year, maybe even 10-year leases. So as these come up for renewal, the environment may have dramatically changed in terms of how many workers that company has coming in on a daily basis. So there's a lag effect there. Higher interest rates are pinching the sector as well. as is the fact that regional and mid-sized banks are big lenders in the commercial real estate space. They've been under pressure, as the piece mentioned. So all these things are combining to create a pretty nervous market right now, I would say.
I've got a couple friends who own some office buildings in, say, Seattle, for example, and they used to have customers and clients like WeWork who would take hundreds of thousands of square feet, and they've scaled back. Big companies, forget Amazon for a moment, but let's talk about just other companies. They're also requiring less office space, right? But at the same time, they're trying to maintain a certain price per square foot, which is how they value essentially office buildings if you're a landlord. Are they going to be able to maintain this price, or ultimately are they going to have to cut the rate of what they rent out for, or give away more bonuses when you sign on to a lease, or probably a combination of the two?
I think it's definitely a buyer's market right now. I mean, I think that these landlords are going to have to offer concessions, whether that's lower prices or other kinds of breaks, because right now there's just not a lot of demand for commercial real estate. And then we throw in the possibility of a credit crunch. I think sometimes people throw that term around too much in the consumer space, because I don't think we're seeing that on the consumer side of things right now. But I do think what we're seeing is much closer to a credit crunch in the commercial real estate space, because I just don't sense a lot of lender or investor appetite for these kind of loans right now.
I saw, Ted, I saw a couple buildings in San Francisco were being thrown into receivership. And when I saw who actually did that, these are fairly large, typically real estate investment trusts or large companies that are doing it. How can they explain to me how they can take an office building, say, I don't want it anymore, or it's not profitable anymore, and they just get rid of it, but yet the rest of the company can still exist profitably? Is every building sort of separate, or is it one big giant entity and you have to worry about? In other words, who's really exposed in the event of a default?
Well, I think the property managers and investors, could definitely be on the hook there. The lenders, I think there is some worry there, for all the above. San Francisco is an especially interesting example, because that's really a company town when we think about the tech industry. And that's been hit so hard by layoffs and rising interest rates. The fact, too, that some of those companies probably grew much faster than expected during the pandemic and now are coming back to earth. And also tech lends itself more to remote work. So I think it's kind of this perfect storm for the San Francisco area. We've seen a number of the regional banks that have been under pressure have strong ties there, like Silicon Valley Bank and First Republic. I think there's really a lot of crossover there. I've seen vacancy rates around 25% in San Francisco, which is much higher than the national average. So I think that's one that's going to have to shake itself out, probably over a longer period of time, because like I said, a lot of times we're talking long-term leases. So there are some
Ted,
that are just kind of biding their
Ted,
time
with
there.
the 25% vacancy rate, I know that's traditionally high, but I look at a place like, say, Seattle or Washington, D.C., you're probably in the teens right now in terms of those two markets. Is there a number that the vacancy rate goes to that essentially you say this building or this developer is in trouble? And the reason I ask that, if you look at these nationally traded REITs, a lot of them are providing yields of 13, 14, 15, 16, 17%. The stock price or the price of these companies have dropped 30, 40, 50%. So people are already anticipating a significant reset in terms of the market value. Is the worst over?
I don't have a precise number in mind, but I think that you're getting at an important point, which is that there is this big reset going on, and it's in commercial real estate and it's in other sectors as well, because the Fed has dramatically raised the price of money over the past year and a quarter. And those 10 interest rate hikes have really changed, I think, a lot of investor demand. So, we've got kind of the dollars and cents part of this, and then we also have the changing nature of work and commuting and hybrid and remote work. So I think that there is a big shakeout going on here. And I think the answer is probably dependent on the company and the market. But yeah, I think that there is definitely a big repricing there. I think this is one of the sectors that's been hit the hardest by pandemic trends and interest rate trends.
Well, we're out of time, but I'm going to have you back again, and we're going to talk about REITs, because for investors, that's where they invest their money. That's where they get their yield. These prices keep dropping. Maybe you and I can buy an office building. Ted, good to see you. Thank you.
Thanks for having me.